Welcome back to the Deep Dive. Today we're diving into something that's, well, kind of a huge deal in the business world. How companies account for those moments when they, decide to join forces, merge, acquire all that.
It's the backbone of how companies grow and change, really.
Exactly. And you, our amazing listeners, you've given us a treasure trove of resources to dig into.
Mm.
We've got the IFRS 3 standard itself, obviously, but also some really helpful guides and even responses from the ISB. Those are the folks who set the IFRS and some of the finer points of how these rules play out in real life.
So quite a bit of material to wade through.
Yeah, it's a lot. But our mission today, and I think it's a worthwhile one, is to cut through the jargon and the complexity and give you, our listener, that core understanding of how business combinations are accounted for under IFRS 3.
It's about seeing the logic behind the numbers, right? Because these deals, they make headlines, they shake up industries, and understanding the accounting can unlock a whole new level of insight into what's really going on.
Couldn't agree more. And whether you're, let's say, prepping for a big strategy meeting at work, or just trying to make sense of the latest financial news, or even if you're just someone who's genuinely curious about how all this merger and acquisition stuff gets reflected in a company's books, understanding IFRS 3, it gives you a powerful lens.
It's a bit like, having that decoder ring for a secret language. Once you have it, you can start to see the patterns and understand the messages behind the numbers.
100%. And don't worry, we're not going to get lost in the weeds here. We're going to stay focused, stay clear, avoid the jargon overload, and hopefully have some fun along the way, right?
Definitely. We'll keep it engaging.
Awesome. So to kick things off, we've got to start with the basics. What is a business combination in the eyes of IFRS 3? What are those key elements that trigger all these rules?
Okay, so at its heart, IFRS 3 defines a business combination as the bringing together of separate entities or businesses into one reporting entity. So you've got at least two distinct entities, they come together, and now you've got one entity for reporting purposes. Simple enough, right?
Sounds simple, but I'm guessing it gets a bit more nuanced.
Oh, absolutely. And here's where it gets interesting, and maybe even a little tricky. The real key, the real distinction that you need to grasp is understanding when what you're buying, what's being acquired, actually qualifies as a business, as opposed to just a bunch of assets.
Like I'm buying a building versus buying a whole company that operates in multiple buildings.
That's a great example. IFRS 3 is really trying to make sure that we don't overcomplicate things. If it's a simple asset purchase, then we don't need to bring in the whole arsenal of business combination rules. But if it's a business that's being acquired, well, then we need a more robust framework to capture all the complexities.
Makes sense. So to help us figure out if something is a business in the IFRS 3 sense, the standard gives us this detailed definition, right? And it talks about needing inputs, processes, and the ability to create outputs.
Right. Think of it this way. Inputs are those essential resources, the raw materials, the labor, the intellectual property, whatever it is. Processes are how you transform those inputs. It's the know-how, the systems, the actual operations. And then outputs, well, that's the goods or services you're providing to the market.
And what's interesting is that the standard says you don't necessarily need to see outputs right away. It's the ability to create them that matters.
Exactly. Think of a company that's, developing a new drug. They might not have any actual product sales yet, but they've got the scientists, the labs, the clinical trials, all pointing towards that future ability to generate revenue from that drug. That's a business, even without immediate outputs.
This all seems pretty clear-cut so far, but I have a feeling it's not always that straightforward.
Oh, you're absolutely right. There are definitely some gray areas. And the definition of a business, it's actually evolved over time as the IASB has gotten feedback and clarified things. One big change came in 2018. They really focused on making sure that those processes we talked about, the ones being acquired, that they're not just, any old process. They have to be substantive. They have to be really crucial to the ability to generate outputs.
So a company can't just claim any random internal process as being part of the business they're acquiring.
Exactly. It needs to be more than just window dressing. It needs to be genuinely integral to the operations. The 2018 amendments also narrowed down what can be considered an output. It's really about ensuring we're focusing on the core of what makes a business tick.
I bet this is a big deal for companies trying to figure out how to structure these transactions, right?
Oh, for sure. It has huge implications. The more specific, the more legally defensible you can make the definition of an asset, the more likely it is to be recognized separately from Goodwill. And that can have a big impact on the balance sheet and how you depreciate or amortize things going forward.
Okay, so all these nuances, all these details, it can feel a bit overwhelming. The standard, though, It tries to give us some practical tools to work with, right?
Right. And one of the most useful tools is the concentration test. It's a way to quickly filter out some transactions that might seem like business combinations at first glance, but really aren't.
How does that work?
It's pretty straightforward. You look at the fair value of all the gross assets you're buying. If practically all of that value is concentrated in one single asset, like, say, a piece of land or a factory, or even a group of very similar assets, then it's highly likely that we're not dealing with a business combination. It's more likely just a straightforward asset acquisition.
So if I'm buying a company that owns a shopping mall, and that mall represents like 95% of the company's value, that's probably not a business combination.
You got it. It's about looking at where the value lies and whether it's spread across a diverse set of inputs and processes or really concentrated in one key thing.
That makes a lot of sense.
Yeah.
Now, to help us wrap our heads around all this, IFRS 3 also gives us some examples, right?
Yes, it does. And these can be super helpful for seeing how the principles actually play out.
Let's walk through a few. So first up, we've got the classic scenario. A company buying a controlling interest in another company that's out there operating in the market.
That's your textbook business combination. You're acquiring a stake that gives you control over the decision-making of another company, its operations, its future. No surprises there. IFRS 3 kicks in full force.
But what about this?
Yeah.
You buy a property development company. It's got a bunch of subsidiaries,
Huh?
but each one is focused on a single development project. Is that a business combination?
This is where it gets interesting. At first glance, you might think, well, each subsidiary is just doing one thing, one project. But you got to step back and look at the bigger picture. You've got this parent company managing all these different projects, allocating resources, overseeing the development process across multiple locations. That, taken as a whole, looks a lot like a business, doesn't it?
It does. It's like a portfolio of projects all managed under one umbrella.
Exactly. Now, compare that to something like, buying the payroll department or the central accounting function of another company. Those are important activities, sure, but they're typically seen as support functions. They're not the core essence of what makes a business in the IFRS 3 sense.
So you're not really acquiring the ability to generate outputs on their own. They're just pieces of a larger puzzle.
Exactly. And here's another one that can trip people up. Buying a shell company.
A shell company, those are always a bit mysterious. What are we talking about here?
A shell company, it's basically a company that exists legally, it's got its registration, its articles of incorporation, but it's not really doing anything. There might be no actual operations, no employees, no real business processes in place.
So if I buy a shell company, is that automatically a business combination?
Not necessarily. This is where you really have to look beyond the legal form and dig into the economic substance. If the shell company truly has minimal operations, no significant processes, and no real capability to create outputs, then it might not meet that IFRS 3 definition of a business.
It's like buying an empty box, basically.
In a sense, yeah. You're acquiring the legal structure, but not necessarily a functioning business.
Okay, here's a scenario that feels a little trickier. Let's say SME-A, that's a small or medium-sized enterprise, buys the telescope division of SME-B, another company. But SME-B holds on to its marketing department. Would that be a business combination for SME-A?
Now, that's a good one. This is where the 2018 amendments and that emphasis on substantive processes really come into play. The big question you have to ask is, did SMEA acquire all the necessary inputs and processes to actually make and sell telescopes on its own?
Because if they can't market the telescopes, can they really generate those outputs?
Exactly. If SMEB's marketing department was truly essential for bringing those telescopes to the market and wasn't part of the deal, then it might suggest that what SMEA bought wasn't a complete business under IFRS 3. It's a judgment call for sure, and you'd need to look at all the specific facts and circumstances.
So lots of nuance there. Now, before we move on to the next stage, I did notice that the standard specifically calls out some things that are not business combinations.
Yeah, it's important to know the boundaries, right? So forming a joint venture, that's specifically excluded from IFRS 3's definition.
Right, so if two companies decide to pool their resources and create a new entity together, sharing control, that's a whole different set of rules.
Exactly. Joint ventures have their own accounting standards, and it makes sense. It's a different type of relationship than a full acquisition. And then there's the whole area of common control combinations, which also get treated differently.
Common control, can you unpack that for us? Why are those handled separately?
Sure. So imagine you've got a group of companies, all ultimately owned or controlled by the same individual or family. Let's say they decide to restructure, maybe merge two subsidiaries. That's a common control combination. The key here is that the ultimate controlling party hasn't changed.
It's all staying within the same economic family, so to speak.
Precisely. And the IASB, they took a long look at this and decided that requiring the full fair value accounting that IFRS 3 mandates, it just didn't make as much sense in these common control situations. The users of those financial statements, they're already aware of the common control and the information needs are a bit different.
So what happens in these cases? If IFRS 3 doesn't apply, what rules do they follow?
Well, this is where IAS 8 comes in. That's the standard on accounting policies, changes in estimates, all that good stuff. Basically, management has to develop an accounting policy that provides relevant and reliable information for these common control combinations.
So they have a bit more flexibility.
To a certain extent, yes. And often what they'll do is try to apply IFRS 3 by analogy as a starting point. That's generally considered acceptable. But what's more common is to use what are called predecessor value methods.
Predecessor value methods. That sounds intriguing. What's the basic idea there?
The idea is that instead of restating everything at fair value on the date of the combination, you essentially carry over the existing book values of the assets and liabilities from the combining entities into the consolidated financial statements.
So you're not starting fresh with a fair value revaluation.
Nope. You're looking back at the historical accounting values within the combining entities. It reflects that continuity of control.
Okay, so common control combinations, they've got their own set of considerations.
Mhm.
But let's jump back to IFRS 3 for a second. We've established what a business combination is, but now we need to figure out who's calling the shots, right?
Absolutely. Once you've determined that it is a business combination, the next crucial step is identifying the acquirer,
Why is that so important?
because it dictates how the entire transaction is accounted for. The acquirer's perspective drives the accounting. So IFRS 3 gives us a bunch of indicators to help us figure this out.
Like a checklist?
Kinda, yeah. It's not a hard and fast rule, but it's a way to assess the situation and figure out who's really in control. One of the first things you look at is size. The entity that's significantly larger in terms of, assets, revenue, all that, that's often a strong indicator that they're the acquirer.
Makes sense. The bigger fish swallows the smaller fish kind of thing.
Yeah, in a lot of cases. Another indicator is who initiated the deal. Who approached whom? Who is the driving force behind the combination? That can provide valuable insights into who's really taking the reins.
What about those situations where a brand new company is created just to make the acquisition? How do you figure out the acquirer then?
Good question. So if the new entity, the one that's been set up, if they're issuing their own equity, their own shares to fund the acquisition, then one of the pre-existing entities that are coming together is usually deemed the acquirer.
Okay, so it's like one of the original companies is using this new entity as a vehicle to make the acquisition.
Precisely. On the other hand, if the new entity is using cash or other assets or even taking on debt to make the acquisition, then it's more likely that the new entity itself is considered the acquirer.
So it depends on how the deal is structured and funded. What about the ownership structure after the deal closes? Does that give us clues?
Absolutely. You got to look at who ends up with the majority of the voting rights in the combined entity. Whoever controls the voting power, they're usually presumed to be the acquirer. You also want to consider who has the power to appoint or remove the majority of the governing body, the board of directors.
Right, so it's about who gets to make the big decisions at the end of the day.
Right. And don't forget about the terms of the share exchange. Sometimes those terms can give one party more sway over the combined entity, even if their voting rights aren't technically a majority. And then there's the senior management team. Who are the key decision makers in the new organization? That can be a telling sign.
So it's not just one factor. It's a whole bunch of things that you have to weigh together. Now, I did see something in the materials about reverse acquisitions. That sounds a bit counterintuitive.
It does, right. It's kind of a head scratcher at first. Basically, in a reverse acquisition, the company that legally issues shares, they're the legal parent. They're actually the accounting acquiree.
Wait, so the company that's technically buying the other one is actually treated as the one being acquired?
Yep, you got it. It seems backwards, but it happens more often than you might think. A common scenario is when you've got a private company that wants to go public, but they don't want to go through the whole traditional IPO process. So what they might do is merge with a smaller, already public company, often what's called a shell company.
So the small public company legally buys the bigger private one, but for accounting purposes, it's flipped.
That's it. It's all about the economic substance, not just the legal form. And the consolidated financial statements, they'll be presented as if it was the bigger private company that acquired the smaller public one, except for the equity structure, which reflects the legal reality.
Okay, so reverse acquisitions, they can be a bit tricky, but the key is to remember that substance over form thing. Now, let's assume we've figured out what a business combination is, we've identified the acquirer. What's the next big milestone? When does the accounting for this whole thing officially start?
It all hinges on the acquisition date. That's the date when the acquirer actually obtains control of the acquiree.
And this isn't always the same as the legal closing date, right?
You got it. Sometimes they line up perfectly, but not always. You have to look at the substance of when control is truly transferred. It's about when the acquirer can actually start directing the financial and operating policies of the other company, really using it to generate benefits from its activities.
So signing a big contract, that's not necessarily the end of the story.
Nope. It's about that moment of genuine control. And IFRS 3, it gives us a handy definition for what that means. It's about the power to govern the financial and operating policies of the acquiree.
Can you give us an example of when the legal closing date and the acquisition date might be different?
Sure, imagine this. SME A signs a deal to buy SME B. But there's still some strings attached, some restrictive rights on SME B's shares that prevent SME A from having full control.
Like, they can't make major decisions without approval from someone else.
Exactly. Maybe there are some shareholder agreements or some regulatory approvals that are still pending. Even though the paperwork is done, the legal closing has happened, the acquisition date, that moment when SME truly gets control, wouldn't be until those restrictive rights expire or get lifted.
It's like having the keys to the car, but not being allowed to drive it yet.
That's a good analogy. It's about that moment of genuine freedom to steer the ship. Okay, so now we've got our definition, we know who the acquirer is, and we've pinned down the acquisition date. Now comes the nitty-gritty, the detailed stuff.
The part where the accountants really earn their keep?
You could say that. Now we have to recognize and measure all the assets that have been acquired and all the liabilities that have been assumed in this business combination. And this is where a really important principle of IFRS 3 comes into play.
Lay it on us.
The acquirer has to recognize the assets and liabilities at the acquisition date. But here's the key. The amounts that they recognize might be different from how the acquirer had them recorded in their own financial statements.
Why is that? Why the potential discrepancy?
Because the acquirer is coming in fresh with a new perspective, they're reevaluating everything based on fair value at that point in time. It's like they're taking inventory of everything they've just acquired and saying, okay, what's all this stuff really worth right now?
So it's a fresh start, a new valuation.
Exactly. And the general rule under IFRS 3 is that all those identifiable assets acquired and liabilities assumed, they get measured at their fair value on the acquisition date. There are some exceptions, but that's the starting point.
Fair value. That's a whole other deep dive we could do.
Oh, for sure. It can get pretty complex, especially for things that aren't actively traded in the market. But the basic idea is, what would a knowledgeable, willing buyer pay for this asset in an arm's length transaction?
Okay, so lots to unpack there. But let's dive into some of the specific types of assets and liabilities that we often see in these business combinations. First up, restructuring obligations. What's the rule there?
All right, so if you're analyzing one of these deals, you need to know that the acquirer, they only recognize a restructuring obligation if the company they're buying, the acquiree, already had a present obligation for restructuring costs on the acquisition date. It has to be something that was already in the works.
So if the acquiree had announced a plan to close a factory and they had already started making those provisions, that would get recognized.
Exactly. That's an obligation that existed at the acquisition date. But here's the catch. If the acquirer comes in and says, you know what, we're going to restructure this whole business, we're going to close down some divisions, lay off some people, all those costs, they're treated as post-acquisition expenses in the acquirer's own financial statements. They don't get bundled into the acquisition accounting.
So it's all about timing and who initiated those restructuring plans. Makes sense. Now, intangible assets, those always seem to be a big deal in these acquisitions. How do they get recognized and measured?
They're often a huge part of the value, especially in today's knowledge-based economy. But for an intangible asset to be recognized separately from Goodwill, it has to be identifiable. IFRS 3 gives us two main ways to figure that out.
Two tests for identifiability.
You could call it that. The first one is separability. Can you sell it license it, or exchange it on its own, or maybe along with a related contract or asset. If you can, then it's identifiable.
So something like a well-known brand name or a valuable internet domain name, those would usually be recognized separately.
Exactly. Those are classic examples. They've got their own standalone value. And the other test is the contractual legal criterion. Does the intangible asset arise from a contract or some other legal right? If it does, then it's identifiable.
So trademarks, patents, copyrights, customer lists that are based on contracts, all those would qualify.
Precisely. And here's where it gets even more interesting. The standard says that even if selling the asset separately isn't really practical, if it meets that contractual legal criterion, it can still be recognized separately.
Can you give us an example of that?
Sure. Imagine a company that's developed a unique technology, and they've got a patent for it. They've also granted an exclusive license to another company to use that technology. Now, selling the patent without the license, or the license without the patent, it might not make much sense from a business perspective. But the fact that they both arise from legally binding contracts means they meet the contractual legal criterion and should be recognized as separate intangible assets.
So it's the legal underpinning that matters.
Precisely. Now let's talk about customer relationships. Those are obviously valuable, but are they always recognized as separate intangible assets? They can be. If the acquired company has formal contracts with its customers, then those customer relationships, as well as any backlog of purchase orders under those contracts, they typically meet that contractual legal test.
But what if there aren't formal contracts?
Even without contracts, if there's a consistent pattern of business dealings, a clear process for ordering, fulfillment, payment, and it's been going on for a while, then there might be an argument for recognizing a customer relationship intangible asset. It's about demonstrating that there's a real economic relationship there, even without a piece of paper.
So it's about more than just a one-time transaction. It's about that ongoing relationship. Now, a lot of times, companies are acquired for their talented workforce. Does that get recognized as a separate intangible asset?
This is a really important point. A skilled workforce, a team of experienced engineers or scientists, that in itself is generally not recognized as a separate intangible asset. The value of having that team in place is considered part of goodwill.
Why is that?
It comes down to control. The acquirer doesn't necessarily have a contractual right to those employees' future services. They can quit, they can go work for someone else. It's not like owning a patent. However, the knowledge and skills of those employees, they absolutely contribute to the value of other intangible assets that are recognized.
So if they've developed proprietary technologies or built strong customer relationships, those assets get recognized and the employees' contributions are reflected there.
Exactly. It's about capturing the value where it can be reliably identified and measured. Now, here's another interesting one that we sometimes see. Reacquired rights.
Reacquired rights, what are those?
Imagine this. Company A grants a license to Company B to use their technology. Later on, Company A acquires Company B. So they're essentially taking back that license they had previously granted. That's a reacquired right.
They're getting back something they once owned.
Precisely. And under IFRS 3, those reacquired rights, they have to be recognized as separate intangible assets. They're not just lumped into goodwill. And they're typically amortized over the remaining term of the original agreement.
Makes sense. You're essentially restoring something to its original value.
Yeah.
Okay, let's shift gears and talk about liabilities. How do those get handled in a business combination? What about things like contingent liabilities, like lawsuits or potential environmental cleanup costs?
Those definitely need to be considered. So if there's a contingent liability that the acquirer is assuming as part of the deal, it gets recognized at its fair value on the acquisition date. But there's a catch. It has to meet two conditions. First, it has to represent a present obligation that arose from past events.
So something that already happened, not just a potential future problem.
Right. And second, its fair value has to be reliably measurable. If it can't be measured reliably, then you don't put it on the balance sheet, but you do have to disclose it in the notes to the financial statements.
So if there's a lawsuit going on, the acquirer has to try and figure out how much that lawsuit might cost them down the road and record that as a liability.
Exactly. They might need to bring in lawyers, experts, consultants, all sorts of people to help them estimate the probability of losing the lawsuit and how much they might have to pay out.
What if the seller agrees to cover some of those potential costs? Like they say, hey, if we lose that lawsuit, we'll reimburse you.
That's an indemnity. And in that case, the acquirer would recognize an indemnification asset, also measured at fair value. It's basically their right to be reimbursed by the seller.
So it offsets the liability to some extent.
Exactly. And here's a little detail from the standard. You don't need a separate allowance for doubtful accounts for that indemnification asset. The uncertainty of actually getting that money from the seller is already factored into the fair value.
Makes sense. It's all built in. Now, we talked about operating leases before. What happens to those when a company gets acquired?
So if the company being acquired is leasing some assets, like equipment or buildings, under operating leases, the acquirer doesn't automatically recognize an asset or a liability for those leases on the acquisition date. But they do have to do something important.
What's that?
They have to look at each of those operating leases and figure out if the terms are favorable or unfavorable compared to what they could get in the market right now.
So are they getting a good deal or a bad deal on those leases?
Exactly. If the terms are favorable to the acquiree, meaning they're paying less than market rate, then the acquirer recognizes an intangible asset. It's like they've acquired a benefit, a below-market lease.
And if the terms are unfavorable, meaning they're paying more than market rate,
Then they recognize a liability. They've essentially inherited an obligation, an above-market lease.
so it's all about comparing those lease terms to what's out there in the marketplace.
Right.
Now, we've touched on a lot of different types of assets and liabilities,
Mm,
but there are a few more we should probably mention.
for sure. We've got employee benefit obligations. Those are accounted for based on IS 19, so there's a whole other set of rules there. And then we've got deferred taxes, which are recognized and measured according to IFRS 12. And of course, those reacquired rights we talked about earlier.
So lots of moving parts. But each of these areas, it's got its own specific guidance within the context of a business combination.
Exactly. You're basically bringing together all these different accounting standards and applying them to this one big event.
Now, let's talk about contingent consideration. This is where things can get a little more, I don't know, uncertain.
Yeah, contingent consideration is when part of the purchase price depends on future events. It's like saying, hey, we'll pay you this much up front, but if you hit certain targets, if certain things happen down the road, we'll pay you even more.
So there's a bit of a gamble involved.
In a way, yes. And IFRS 3, it tries to capture that uncertainty. So the acquirer has to recognize the contingent consideration at its fair value on the acquisition date.
Even though they don't know for sure if they'll have to pay it.
That's right. It's about estimating the value of that potential future payment. And then as things unfold, as those future events happen or don't happen, the fair value of that contingent consideration might change. Those changes are generally recognized in profit or loss.
So if the acquired company hits those performance milestones and the buyer has to pay out more, that's going to impact their income statement.
Exactly. Unless it happens within a certain time frame called the measurement period. That period can last up to 1 year from the acquisition date. And if the changes in fair value during that period are because of new information about things that already existed at the acquisition date, then you can adjust the initial accounting, including goodwill.
So it's like you get a little window to fine-tune things based on new information.
Right. And you also have to consider the ongoing impact of any deferred contingent consideration. The present value of that obligation, it unwinds over time, and that also affects profit or loss. It's a bit like interest expense, but for these future payments.
Okay, so contingent consideration, it can definitely add some complexity. Now, what about those situations where the company being acquired have outstanding share-based payment awards? Things like stock options that have been granted to their employees. How does the acquirer handle those?
If the acquirer decides to replace those existing awards with their own, you have to allocate the value of those new awards. The portion that relates to services the employees provided before the acquisition, that's considered part of the consideration transferred in the deal. It's like saying, hey, part of what we're paying for is the value of those employees' past contributions.
And the portion that relates to services they'll provide after the acquisition.
That gets treated as employee compensation expense by the acquirer. They're basically taking on the cost of those future services.
Makes sense. It's all about figuring out who's getting what benefit. Now, one last scenario I wanted to touch on. What happens if the acquiring and acquired companies already had some kind of relationship before the deal?
That's not uncommon. Maybe they were suppliers to each other, or maybe they had a joint venture, or even a legal dispute. And if the business combination effectively settles that pre-existing relationship, the acquirer has to recognize a gain or loss related to that settlement.
So if they were suing each other and now they're merging, that lawsuit goes away and they have to account for that.
Exactly. And how that gain or loss is measured depends on the nature of the relationship. If it was a non-contractual relationship, like a lawsuit, then it's measured at fair value. If it was a contractual relationship, then it's based on the more favorable or unfavorable terms of the contract compared to what they could get in the market.
So lots of nuances there, depending on the specifics of the relationship. Okay, we've covered a ton of ground here. We've talked about recognizing and measuring all sorts of assets and liabilities. But now we get to the big one, the one that often grabs the headlines, goodwill.
Ah, goodwill. The mysterious, intangible asset that can make or break a deal.
It's like the wild card in all these business combinations.
In a way, yes. Goodwill essentially represents the value that's left over after you've accounted for all the identifiable assets and liabilities. It's the premium that the acquirer is willing to pay above and beyond the tangible stuff.
So if I'm buying a company for $100 million dollars and all their identifiable assets and liabilities net out to, say, $80 million, then there's $20 million of goodwill.
Exactly. And
Yeah.
that 20 million, it reflects all sorts of things that are hard to pin down precisely. It could be the value of the company's brand, its reputation, its customer relationships.